presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello, everyone, and welcome to the Compak Asset Management YouTube update for January the 8th, 2024. I'm Mo Ansari, President of Compak Asset Management. Thanks for joining me today. First of all, don't forget to go to the compak.com/media page where you can get all of the information. You can sign up for this weekly update, the podcast, the apps. You can also make appointments to come down to the offices or set up a YouTube Zoom meeting. We'll do that anywhere, anytime that you want to do. So go to compak.com/media and sign up. Last week, the market was down 1.5% for the S&P for the first 5 days. That's a little bit of a concern. As the old saying goes, first 5 days of January, that goes January, and so goes January, so goes the rest of the year. So we'll have to wait and see. We're having a great day today. The markets are popping back up. I think the one to watch is the small cap. It gapped lower, and it filled a gap from a couple of months ago, and now it's coming back up. Now, if it can gap higher, leave an island bottom, that would be a good indication. Dow was down about 0.5%. The Russell, the small cap, was down 3.73%, big correction, but we had seen a huge rally also in the small cap. So we're just backing and filling on that. The NASDAQ also down 3.23% last week. Best sector, the defensive sectors, healthcare, utilities, energy, financials were the best ones. Worst sector last week, technology. That's what we're seeing. That has been the theme so far this year. You look at the bottom of the entire sectors, and you can see technology is one of the ones that is the one that's on the bottom. It was on the top all last year, and we're seeing much more of the defensive areas of the market do better. So we'll have to wait and see how this plays out over the next few weeks. Oil was slightly higher, but it's down big today. Gold also slightly lower. Just about everything was down last week, so we'll see where we go from here. Interest rates were up, and that is one of the things that we're starting to see. The yields are starting to come back up. They pushed 4%, and that is a critical to look at the 10-year. That is something to watch. It was 3.88 the week before, and then we saw it pop back up to about 4.05, which was last week. If you saw the YouTube update, you saw the chart. 4.045 was the number that I was looking at, the 200-day moving average on the 10-year yield, and that has tested it and is starting to come back down today. Again, as I mentioned earlier, big January trends predict the year. You can see that whenever we are positive in January, we get positive returns for the year. Negative January, negative returns for the year. You can see that's except in 2016 where we started negative, had positive, started positive, ended negative. So that's it works, but not all the time. But last year, 22 we were negative, and that was it. 23 we were positive. So it does give us some kind of idea, but it's not something that we have to really watch. But it is something that is a high percentage seasonal tendency. Job openings last month came down, which is a good sign that the job market is slowing, but the payrolls increased to 216,000, more than expected. Expectation was about 175,000, so we got a little bit more, and that sort of made everybody say, wait a minute, interest rates are going to remain higher for longer. And I'll talk about that a lot more today on the podcast, the podcast that we do every Monday afternoon, where Javed and I are going to talk about that. Is that a good sign or a bad sign? With the rates coming back up a little bit, is that good or bad? We'll talk about that in a lot more detail. Wages grew, which is also a good sign because people have more money to spend. This week, the big reports are going to be the CPI and the PPI, this Consumer Price Index and the Producer Price Index. Looking at the technicals, S&P just hovering right around 4,700, which is the 20-day moving average. We came down to today, last week, tested it, broke it for a day or so, then pop right back up. Again, if we can get above this high and get above to 48,808 to 49.20 24, that is the target that I'm looking at for the short term. Above 48.18 would set a new all-time high for the S&P, and we're not too far from that. We were up to 4,800 right about here, and then we dropped back down, but that's wave 3. Wave 4 is what we're getting. Once we complete wave 4, then we should head up to wave 5 is what I'm looking for. Weekly chart, also the same thing, but we're target long-term 5,000 to 5150. I think it'll take a year and a half to get there, but that is being projected. It's a Fibonacci projection from this high. We are going to go through we have gone through an ABC correction here in the market, and we'll see. Now it's time for the market to consolidate a little bit. NASDAQ seems to have completed a fifth wave right here. And after that, we get an A, B, C correction. So that's what we're seeing. We got below the 20-day, but today we're back above the 20-day. I think, again, we're going to sort of go back and forth in this area for a period of time. As long as we stay above 14.4, and then this gap does not get filled around 14,000. Those are the two support areas that I'm looking for. 14.4 and then 14,000 are the two numbers on the downside I'd keep an eye on. But again, I feel that the NASDAQ is going to sort of go sideways to lower. That's, we had this huge run up last year. I think we're going to see more of a sideways in the NASDAQ. The weekly chart, again, target was right around here. That's the short-term target. Long-term target is up here, 17,000. But we have to get above the 16,000 number before we can really start getting positive. I think here we've completed fifth. Now we go through an ABC, quiet period. Interest rates, as I mentioned, came back up to the 4% area from this 3.8. As long as we do not get much below this 3.4 area, 3.7 to 3.4. 3.4, with interest rates, if they start coming down, will show a weakness in the economy. That's the only reason why interest rates would plummet. And that would not be good for the stock market. So if we can stay in a range between about 3.5% to 4% for the 10-year note, that would be positive. Seems like we're at the positive. Today we're down to 3.99. We were up earlier on. Now we're back down. If we get below the 20-day and can close below, then we could start wave 5 to the downside in interest rates. And as interest rates come down, that would be positive for the stock market. Crude oil, which had popped back up, this was wave 1 to the downside, 2, 3, 4. Now we should look for 5. Right around here, 68 to 66 is the downside target there. Gold hit a high, popped back down. Now we've gone, looks like a fourth wave, but we've used up a lot of this positive energy that we had all the way up here. We've gone back and forth. I think we're going to stay in this range, about 2,100 to about 2,000, maybe just a little bit below that is what the targets are for the gold market. I don't expect to see much in gold. One chart that I'm watching carefully, as I mentioned earlier, is the small cap index, which I think is going to be the best sector in 2024, is the small caps. As interest rates come down, they're going to be the biggest beneficiary. Looking at this, we had gone up dramatically from the low in October, up a lot. Then we started to come back down. We gapped lower here, right here, and then we filled this gap that we had. Today we're up quite a bit, about 1.5%. And if we can get about 197 for the IWM, that's the ETF for the small caps, if we can get above that, that would be very positive. Or if we come up here and then gap higher, leaving a gap here and then gap higher, that would be an island bottom right here. And that usually gives us a turning point in the markets. Those are my short-term views, what I think, what I'm looking at right now. Again, for a much more detailed analysis, Javed and I will do a long podcast that you can tune in. Again, all of that is free. All you have to do is go to compak.com/media, download the app, and you will get all of that information where we'll talk about in detail about what we're looking at and what about these interest rates and what does it mean for the stock market. Have a wonderful week. I will be back with you next week. Until then, good trading.
presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.